Okay, here in this video we're going to look at types of businesses and specifically what you can see in red below, the factors influencing the choice of legal structure. And there are three main factors. We've been looking at unincorporated and incorporated business entities, sole traders, partnerships, private companies and public companies. Now we're going to look at it from the perspective of, well, what would influence a business owner or manager to choose an appropriate business structure? And there are three main influences that would have an impact on that decision, and they are the size of the business, the ownership that they desire, and also the finance availability that comes with each ownership structure. So choosing a business ownership depends on those three factors, and the point also that's important is that those factors can change over time. As the business grows, a different legal structure may become appropriate because of the size of the business, or also because it needs to access a different form of capital, and it couldn't do that with one business structure, but it could do it if they changed its business structure. So the first factor that has an influence on a legal structure is the size of the business. There are broad generalizations about size and what the appropriate legal structure is for each size of business, but here we'll explore how size might influence legal structure. So firstly, most businesses, as we've talked about in class regularly, most businesses will start out as a sole trader. It's a low-cost form of business. It gives an opportunity for a business owner to open a business with an idea, see if that business is viable and see if that business is going to work. And then if that's the case, that may mean that the business structure progresses and changes over time, but it is the most common structure particularly for a small startup business. If sales increase over time and then further expansion occurs, either geographic expansion or expansion in terms of market share or in terms of employees, that may mean that the business has a requirement for additional capital to purchase assets, to be able to maybe purchase a competitor, to expand new stores like Kathmandu, expanding their store footprint. And with that, means that potentially, as that business grows, there is a need to change the legal structure, to go from a sole trader to a partnership, for example, or even to a private company. A partnership where you can bring in additional partners who can bring in additional capital or additional ideas, or potentially even go into partnership with someone in another state, or a private company structure where you can bring in private shareholders who also can contribute capital by purchasing their shares in that private entity. If expansion is rapid, limited liability may be preferred, and that's an important point also. As the business grows in size, the business may wish to move from an unlimited liability structure of a sole trader or a partnership to a limited liability structure of a private company to protect the owners or the original owners of that business from any issues down the track. The further growth of that business might lead to, I've talked about geographic expansion in state, if we're talking about Australia, but also might mean growth at a multinational level, so expanding overseas. And that sort of expansion certainly requires even further capital. And the solution to that might be to become a public company. If this business wishes to expand, it's going to need significant capital, and the significant capital is probably only available really through becoming a public company. I suppose private equity could be a solution, in fact, but more than likely a public company structure is probably going to be best. That means that would require a prospectus, such as the one we looked at with Kathmandu, and the business becoming a public company, selling its shares to the general public, raising equity capital, and then that capital could be used for that global expansion. To conclude, in the context of size, there is no one-size-fits-all approach. There is no rigid formula to say that this size business must be a sole trader or this size business must be a private company. It depends on the unique situation of each individual business and also the business environment in which that business is operating. Another factor that has an impact on legal structure is the nature of the ownership. If a business wants complete control and ownership, then sole trader is the legal structure that is most pertinent to that particular business. If the business owner or owners wish to have more than one person involved in that business, they want to be able to bounce ideas off each other, they want people with different skill sets, to be those people with different skill sets to be owners in that business, then a partnership structure would be more appropriate. If a business owners want a high level of control over the business, but they also want limited liability, so they want to protect themselves and their personal assets, then a private company would be the appropriate legal structure. The advantage also of a private company is that the owners can change, i.e. one shareholder could sell to another, but the business will continue to operate regardless. Then a public company ownership is related to the number of shares that's owned. So if a business, in terms of ownership, wants to have many more shareholders, and really it comes back to access to capital, then a public ownership structure would be most appropriate for that business. The last point here, as we've discussed in class, is not necessarily relevant to Australia, but if the owner wants to retain ownership and control, then they must hold 50% of the shares. But as I've said in class numerous times, in Australia, for a public company, there are a few exceptions, but generally, one shareholder can't own more than 15% of that public company. The last influence in terms of legal structure is that of finance. And generally, quite often it all comes down to finance. Sole traders and partnerships can often find it difficult to access and obtain and raise sufficient capital for their business, given the liability nature of those legal structures, and the unlimited liability nature, I should say. Traditional sources of finance, and by traditional I'm really referring to banks, they see these legal structures as high risk. Lending to someone with an unlimited liability is seen as much riskier than lending to an entity that has limited liability. So accessing to finance of a partnership and a sole trader is often challenging, and it's often restricted just to capital that comes from the owners themselves. Venture capital or private equity can play a part. They could be a solution where that investment firm takes an equity stake or provides equity to that business or capital to that business. But the loan obstacle and the unwillingness of banks to potentially lend to an entity may lead a business to go down the path of a private or public company. So that the need to access capital can also have a significant impact on the choice of legal structure. There's no guarantees that by changing a legal structure from, for example, a partnership to a private company, that you'll be able to access the appropriate level of capital, but there is a much greater chance that that business will be able to access the appropriate capital that they need.